Okay, so in this video we are going to be discussing Cliff Asness's paper called Fight the Fed Model, and it's going to analyze the relationship between stock market yields, bond market yields, and future returns. So Cliff is going to be arguing against the Fed model, and the Fed model is commonly used to explain that the earnings yield of the stock market, that's its earnings divided by its price, should be about equal to the yield of the 10-year treasuries. And so if the earnings yield of stocks are higher than the 10-year treasury, you might say that stocks are cheap. And if the earnings yield of stocks are below that of the 10-year treasury, you might say that stocks are expensive. So there are three arguments in favor of the Fed model. Those are the competing assets argument, the present value argument, and the empirical data argument. So first, the competing assets argument. This rationalizes that you could either invest in stocks or you could invest in 10-year treasuries. And so if stocks are earning more in the sense of their earnings yield, if they're earning more than the yield of treasuries, it behooves you to invest in stocks. And vice versa, where if 10-year treasuries are earning more than stocks, then you should invest in treasuries. And the present value argument is a bit more sophisticated, but it operates on the premise that within the dividend discount model, the denominator is interest rates. And so if interest rates are higher, then the value of stocks should be lower. And if interest rates are lower, then the value and prices of stocks should be higher. So this leads one to deduce that the price-earnings ratios should be inversely related to interest rates or inflation, which would also affect the level of nominal interest rates. So the last argument for the Fed model is that historically the earnings yield and the 10-year treasury yield have tended to move together. And we have a chart here that shows that, figure 1, where we have the S&P 500 earnings yield in this blue and the 10-year treasury yield in this pink. And we see that they do, in fact, move together. And in fact, the correlation of these is 81%. And for the thought process of lower inflation should yield higher PE ratios, we see that occurrence has actually happened throughout history as well. So next, the author goes through the dividend discount model with a few variations and substitutions to get it in a form where we can understand what might happen if inflation changes. So first we have the well-known dividend discount model where the nominal earnings equal the dividend yield plus the future nominal growth of that dividend yield. And so coming down here, we make some substitutions where the nominal earnings level should equal the company's payout ratio times its dividend yield. So we basically substituted this payout ratio times the dividend yield in place of the dividend rate, and we keep the dividend nominal growth rate here. And next, the author assumes that there's going to be a 50% payout ratio over the future, and that's in line with the historical average. So in place of this payout ratio, we put 50%. And moving on down to the next alteration of the equation, we're trying to form the real earnings of the company, and this is denoted by lowercase letters as opposed to uppercase letters. So the real earnings for the company should equal its nominal earnings minus the inflation rate. And so substituting the equation above into the nominal earnings rate, we get the 50% times the earnings yield, or times the earnings yield plus the nominal growth rate minus the inflation rate. Basically just pulling in this equation in place of this variable and subtracting inflation from it to get the real earnings rate. And so ultimately these substitutions get us to the real earnings for the company should equal 50% of the earnings yield plus the real growth rate. And this is very important because it basically says that your real earnings on that stock are to equal the initial earnings yield that you buy in at, or they're dependent on the earnings yield that you buy at plus the real growth rate of that company going forward. And so what does this mean for our analysis? Let's pretend that the inflation rate changes. For instance, it goes down. Then intuitively, the real earnings for that stock should remain the same because this is the nominal earnings minus the inflation rate. So then we should, from a real perspective, we should still earn the same no matter which direction or magnitude that inflation is. So what does this mean for our equation? This means that this whole equation has to remain the same too if inflation changes. So that means if the inflation rate goes down, then either these variables do not move at all, or they move and offset each other. And the common proponents of the Fed model would argue that if inflation goes down, then this earnings yield needs to go down, and that's through an increase to the price of the stock. and that would be offset by an increase to the real growth rate going forward. But the author in this paper is arguing that maybe this real growth rate figure should stay the same, and that would mean that the earnings yield should stay the same as well. And this is because this real growth rate is basically the nominal growth minus inflation. So if inflation goes down, then so too should the nominal growth rate, part of this variable. And this makes sense that the nominal growth should go down, because that's basically what inflation means, is that if inflation changes, then so should the nominal earnings of the company, as the revenues and expenses move in lockstep with that inflation change. And so if that's the case, and this long-term growth, real earnings growth figure is to stay the same, then really, in relation to inflation, the only measure you should worry about when investing in a stock is what is the earnings yield at the time of purchase. And buying at a higher earnings yield, or equivalently a lower PE ratio, should yield a higher return on that stock, or a higher real return on that stock. Okay, so next the author wanted to confirm empirically how do changes in inflation affect the nominal earnings growth rate. And so the author formed a regression here based on the rolling decade-long nominal earnings per share growth on the S&P 500 and to see the loading on the CPI inflation. And so what he finds is that the nominal earnings growth rate is directly due to almost 100% changes in the inflation. So whatever changes in inflation happen, almost 100% goes directly to changes in the earnings growth rate. And so that falls in line with our thought process of this formula here, that changes in the return of your stock should basically, well, the return on the stock that you own should not change as inflation changes, because those changes of inflation will be reflected in the nominal growth rate, and therefore this price earnings or earnings yield figure should not change. So let's go back down to a little more of the analysis. So the authors add some more color to this analysis with the thought process that stocks are commonly known as a good inflation hedge, and this is because the return should not be affected by the inflation rate, because it's basically a real asset. But bonds are different, because their returns are affected by inflation, because changes to inflation affect the interest rate, which should move the bond prices up or down. So in that sense, maybe bond yields should not be compared to stock yields, because stocks are a real asset, whereas bonds are a nominal asset. The only exception to that might be if we're referring to floating rate bonds. So a good analogy of that might be that for floating rate bonds, as the interest rates move up or down, the prices of the bonds still stay at par. And that's similar to the way that equity prices operate as well, because as the inflation moves up or down, so does the nominal growth rate to counteract that, and so the equity prices remain at par as well. And so you might think of a stock's coupon as its earnings growth rate. And Siegel even said this back in 2002 when he said that changes in the inflation rate cause changes in the earnings growth rate of the same magnitude as the changes in inflation. And that, for that reason, the change in valuation of stocks does not move. So now let's go back and revisit all of the arguments in favor of the Fed model, since we now have an understanding of some counter arguments. So the competing assets argument said that the yield on stocks, the EP, should be in line with bond yields because they're competing assets. But the thing that's being left out of that equation is that the return on a stock is its earnings yield plus its growth rate. So bonds don't have a growth rate. And so in that sense, leaving out the growth rate when considering equities versus bonds may produce a suboptimal result when comparing the two. Alright, so we've got a good example here. Let's say the PE ratio of the market is 12.5. The nominal bond yield is 8%, inflation is 6%, and expected real earnings growth is 2%. So that's in excess of inflation. So that would mean the expected nominal earnings growth rate is about 8%, and that's the 6% inflation plus the 2% real growth rate. So if we plug these figures into equation 3 that we saw before, we get that the return to the stock market should be about 12%. And that's basically a payout ratio of 50% times the earnings yield, which is 1 divided by the PE ratio of 12.5, and then plus the nominal earnings growth rate, which we calculated here. And so the sum of those should give us 12%. And this is basically the current dividend yield plus the nominal dividend yield growth rate going forward. And so since stocks expected return 12% here, and bonds are yielding 8%, then stocks have a 4% premium over the bonds. And since inflation is 6% and the return to the stocks is 12%, then we have a 6% real return on the stocks. So let's go down. The authors are suggesting, well, what would happen if the long-term expected inflation fell by 5%? And this would cause bond yields to fall by 5% also. And so inflation is now 1% because that's the 6% inflation minus the 5% fall in inflation gets us 1%. And the bond yields are now yielding 3% because that's the 8% nominal yield minus the 5% drop in inflation should get us about a 3% yield. And so the real yields remain the same at 2%, and that's basically this 3% nominal yield minus the change in inflation from 6% minus 5% is 1. Gets us the 2% here. And so that would mean our expected nominal earnings growth for stocks should be the 1% inflation. That's basically the 6% inflation we started with minus the 5% that it fell, and then plus the 2% real earnings growth rate that was given initially in this example right here. So then our expected nominal earnings growth is now 3%, whereas before it was 8%. So the drop in the 5% inflation went directly from 8% to 3% earnings growth. So that means nothing changed to the real earnings rate as a result of the inflation. All of the reduction in the inflation went directly to the nominal stock return, which has now gone down to 7% from its original 12%. 12 minus 7 is the 5% drop in inflation. So this change in inflation went directly to a change in the nominal earnings growth rate, which caused the full change to the stock's nominal return. And we see that here, where the PE ratio didn't change at all. It remains at 12.5 as it was initially. So the changes in the inflation and the changes in the interest rates didn't change the price-earnings ratio at all, which is what would be suggested by the Fed model. In fact, the change in inflation caused a change in the growth rate, which changed the future returns to owning that stock. If we were to have gone along with the Fed modelers, we would have found that maybe a PE ratio of 33 is appropriate, when in fact that might have been a poor decision when the PE should have been 12.5. So let's go down to the present value argument. It's argument number 2 here. So the thought is that changes in inflation and therefore interest rates should change the present value of cash flows because that's the denominator in the formula. And so that should change the value of the stock and therefore its price and further its PE ratio. So if interest rates go down, then the present value of the future cash flows should go up, and so therefore the price should go up as well, and so should the PE ratio. And that's true, all else equal, but in fact all else is not equal in this scenario. Because the thing is, as inflation declines, so does the future cash flows due to the reduction in the earnings growth rate. So the reduction in the discount rate should be matched by a reduction in the cash flow rate as well. So the Fed modelers are not taking into account this change in cash flow that's affected by changes in inflation. So argument number 3, this was the most interesting, where we saw in a prior chart, let's go back up to it, that the earnings yield and the 10-year treasury rate move in line with each other since 1965. And in fact, changes or levels of inflation have also been related to levels of the PE ratios. So let's go back down to where we're going to counter this argument. So we know that time period was 1965 to 2001. So let's go look at a chart that is 1926 to 2001. We see here that starting back in 1926, the relationship between these two is not related at all. And in fact, the 0.81 correlation that we found in the prior chart, it was just 65 to 2002, has been reduced to 0.18 when we take into account the full period going back to 1926. So depending on the time period you're looking at, you might conclude differently about the relationship between the earnings yield and the 10-year treasury rate. So even though there might seem to be a relationship between the inflation rates and the earnings yields, or the PE ratios that we saw right here, it might merely be a fallacy of investors making poor decisions So throughout the prior analysis that we discussed up until this point, the arguments against the Fed model, we see that it's not appropriate that the PE ratio should follow inflation, but it does happen, and so the author thinks that it's maybe a mistaking in thinking that the investor has made rather than a theoretical basis for why that happens. So investors may be making poor decisions that is making this PE ratio move with inflation when maybe it shouldn't. And so if the investors had used the Fed model before 1965, they would have not performed very well. And in fact, they would have been long stocks starting in 1932 all the way up to 1965, even though stocks still had ups and downs over this period. So we're going to be exploring a little bit later maybe what are the causes of the differences between this period and this period. So then next here at Table 2, the author runs a few regressions over different time periods. So let's go through how this regression was structured. First we have different time periods, so 1881 to 2001 data, 1926 to 2001, and 1955 to 2001. And this is based on rolling 10-year periods. So in each of these regressions, the dependent variable is the real return on owning the stocks. And the independent variables can be either the earnings yield on the stocks, or the 10-year treasury yield, or the earnings yield on the stocks minus the 10-year treasury yield. Now let's go through what we're trying to accomplish with this chart. So if there's a positive and statistically significant coefficient on the earnings yield, that gives evidence to the validity of the traditional model that says you should only compare earnings yields to securities themselves, not to 10-year treasury rates. Now, if the earnings yield minus the 10-year treasury rate ends up being significant, then we could say there might be some validity to the Fed model that says that the returns, the dependent variable, is related to the spread of the earnings yield minus the treasury rate, which is what the Fed modelers are stipulating. So let's see what happened here. Each of these time periods has a regression of just the earnings yield, just the Fed model yield minus the 10-year treasury yield, and then also a bivariate model of the earnings yield and the 10-year treasury yield as being independent variables. And so in all time periods, we generally get the same result, where we have the earnings yield is statistically significant and related to the real returns on the stock. In fact, it looks like there's almost a 1-to-1 ratio with whatever earnings yield you buy in at for the stock is about what return you're going to get, minus, of course, the intercept here, which is 0.8%. So in this equation, the return you're going to get, or the real return you're going to get, is dependent on the earnings yield you're going to get at the time of purchase. However, when we come over here to the next regression, where we have the earnings yield minus the 10-year treasury rate, we get a very insignificant t-statistic here. So it's not very likely that the coefficient here is different from 0. And so therefore, the difference between the earnings yield and the 10-year treasury may not be related to the real earnings owning that stock. And coming to the third regression, where we have the bivariate, which means we have two independent variables. The only one that was significant was the earnings yield. So we find over this 1881 to 2001 period, the earnings yield was the primary driver of the real return on owning that stock. And it actually results in about 30% of the variation on the real return to that stock. And so this same scenario was done over these different time periods with about the same result. We have here that the earnings yield was highly significant here and here, and the 10-year treasury yield was insignificant. Same thing here from the 55 to 2001 period. And in fact, this 1995 to 2001 period was negative on the earnings yield minus the 10-year treasury yield, which is counter to what the Fed modelers would expect. So now this table was based on rolling 10-year returns. For instance, what were these yields at purchase, and then holding for the next 10 years to see what the real return was. So the next table is table 3. So next we have table 3. We performed the same study, only this time we used 20-year rolling real returns rather than the 10-year rolling returns previously. And we get the same result, where the earnings yield was significantly statistically significant with a high coefficient loading on the real returns. And we also get a high coefficient in the bivariate regression as well. Interesting to see is that the earnings yield minus the 10-year treasury yield variable has a statistically significant t-statistic here, but we find whenever we do the bivariate regression that most of this significance is related to the earnings yield as opposed to the 10-year yield, which adds very little. So it might be more likely the 10-year yield is 0, or rather the coefficient loading on it. Also interesting to see is when we do this over 20-year periods, we get a much higher R squared, and so it's interesting to see how much the earnings yield explains the variation in returns over those 20-year rolling periods. Okay, so next authors use the same study and regressions, but only this time we're doing rolling 1-year real S&P 500 returns. The prior two tables were 10-year and 20-year rolling, so we'll see how well these regressions forecast on a shorter term stance. We immediately see here that R squares are significantly depressed, and it's because it's very difficult to forecast these 1-year returns with the regression. So we know these variables do not explain a very large part of the variation in the returns when we're looking at 1-year returns. We also see the t-statistics are a little bit muted as well, but let's go through each of the periods. Our longest period here, we see that the earnings yield was significant in determining the real returns on the stocks. We also see the earnings yield minus the 10-year treasury yield was significant, although this is mostly due to the earnings yield piece being significant. We see the 10-year treasury yield doesn't add much explanatory power to the regression. So going on to the 1926 to 2001 period, we see the same scenario, significant earnings yield and insignificant 10-year treasury yield. However, when we get up to the 1955 to 2001 period, we see that none of the variables are significant in explaining the 1-year rolling returns. And in fact, at least for the Fed model here, we have a very significant alpha. So something other than the Fed model is explaining these returns. And we've got the same situation down here in the 1982 to 2001 period. And the Fed model is somewhat significant in that scenario, but it's a very high coefficient here. So this would mean that your real return would be 20% plus 4 times whatever the earnings yield minus the 10-year treasury rate is. And so since all of this return is built into the intercept, in order for you to do well during this period, you would basically have to know that you're in a bull market, and you would have to buy stocks to capture this intercept, because this factor is going to be minuscule compared to this one. Not to mention this comes with a very low R squared, so it doesn't explain even close to the amount of variation in returns. Long story short, predicting 1-year real returns is very difficult, and these regressions do a lot better of explaining the 10-year or 20-year returns, as we saw in tables 2 and 3. And in those cases, the real return on owning those stocks was highly dependent on the earnings yield at which you bought those stocks. Okay, so now that we have an understanding of how the earnings yield is related to stock market returns, we're going to look at section 5 here, how PEs and nominal rates really move together. And so what the author has done is created a new regression where we have as the dependent variable the earnings yield, and as the dependent variables we have the 10-year treasury yield and the ratio of the volatility of stocks to the volatility of bonds. And so the thought process is that looking at the relationship of stocks to bonds, stocks should apparently implicitly earn more than the 10-year treasury just from the idea that they're riskier. So this earnings yield should be higher than the 10-year treasury yield to account for an equity risk premium. And maybe that premium comes in the form of some relationship of the volatility of stocks relative to the volatility of bonds. And so this equation still allows the investor to move his earnings yield with the change in interest rates, whether that's an appropriate policy or not. Throughout history, it seems to be the case from some of the prior charts that we looked at previously. So let's see what this equation turns out to be when we look at the prior 20 years of volatility for stocks and bonds and add in that piece to the regression. And so this first equation we look at, well, what would have been the coefficient if we didn't take into account the volatility piece that we had here? See, now we don't have that volatility piece. So how effective is a regression on the earnings yield when we're only taking into account the changes in the 10-year bond rate? And we see that we get some pretty high t-statistics here, but it by no means comes close to explaining all of the variations in the earnings yield over the years, because we have a very low R squared here. So only 3% of the variation in the earnings yield can be related to this equation here. And so if we were to graph that on a chart we see here at figure 3, that regression would have given us expected PE ratios of this pink line here. But in fact, the PE ratios of the stock market varied a lot around this fitted PE. So we can see that that particular regression was not very effective in forecasting the PEs of the S&P 500. So now let's add in this volatility piece here. With this volatility piece, we get an R squared of 58%. So it does pretty good at explaining the variation in earnings yields over the 1926 to 2001 time period. So from this we see that earnings yields of stocks have been the 10-year Treasury yield plus about 2% of the ratio of volatility of stocks to bonds minus a 4.1% intercept here. And now if we were to run the same regression on the 55 to 2001 period, we get about a 79% R squared. So it's a very good explanatory power of the variation of returns or the variation of earnings yield. And so from this we can say that the volatility of stocks relative to bonds has a significant positive relationship to the earnings yield. So investors, if they perceive higher risk for stocks than bonds, they're more likely to demand a higher earnings yield and a lower PE ratio. And so we've also put this into a figure as well. Now that we've added in the volatility difference between stocks and bonds, our fitted PE, this pink line, is much more in line with the actual PE ratios of stocks over time, save a few times throughout history of extremes. So we might say from this regression that we remember that investors using the Fed model would use a 1-to-1 ratio of the 10-year Treasury to earnings yield and determining whether stocks are under or overvalued. And so the fittingness, for instance, for the 55 to 2001 period, where we saw that the earnings yield moved lock and step with the 10-year Treasury yield, was done by investors accurately, but for the wrong reasons that are stipulated by the Fed model. In fact, maybe the earnings yields moved because in line with the 10-year Treasury yield, because the volatility of stocks to bonds were more or less volatile, and not merely because they move in line with the 10-year Treasury yield. So going back down to this chart, we remember in the figure before well, let's go back and take a look at it. We saw that the 10-year Treasury rate was very low compared to what the earnings yield was, but then it fell in line after 65 to 2001. So what happened? Let's go down and look how it is now that we've added in the volatility difference between stocks and bonds. So now this fits better. And why does that happen? It's because during this period, interest rates were generally low, and that's why in the other figure, 10-year Treasury yield was low compared to PE. But now that we've added in volatility difference between bonds and stocks, we're adding in that difference here, which brings the fitted PE up to the actual PE, because during this particular period, stocks were a lot more volatile than bonds, so it's adding in that particular coefficient to the equation. But now, from 65 to 2001, which fitted just like the 10-year Treasury yield, the volatility of stocks was pretty much in line with bonds during that period, so the piece of the difference between stocks and bonds was a lot smaller, so the relationship was pretty much 10-year Treasury yield changes equal changes in earnings yield. And so it would behoove investors to account for the volatility of stocks and bonds when they're assessing what should be the appropriate earnings yield, and not just what is the level of the 10-year yield. Okay, so now that we understand the relationship of 10-year Treasury yields to earnings yields for the U.S. market, the authors want to do an out-of-sample test to see if we come to the same results. So that's in Section 6, the International Cross-Sectional Evidence. So what they've done is perform the same study, only this is across 10 developed and liquid countries, pulling in their equity prices and 10-year Treasury yields. And so first we have the preliminary regression here to see how related are the earnings yields to the 10-year Treasury yield by determining what is the coefficient of this beta here on average across those 10 countries. And we see they get a beta of 0.67. So this earnings yield is significantly related to the 10-year Treasury yield. And so the 10-year Treasury yield somewhat explains the earnings yield, and this is with a significant t statistic and a 32% R squared. So going down, we have the next regressions, which is the returns to those stocks in those countries, and with the independent variable being the earnings yield, and in this regression, adding in the independent variable of the 10-year Treasury for that country. So here we want to see how significant explanatory power does the earnings yield have on the actual returns of the stocks, and then also what is the explanatory power of the interest rates on the returns of those stocks. So in this analysis, we want to see, whenever we are trying to understand the validity of the Fed model, if this B1 is significant, then we could say that the traditional model applies, where higher earnings yields should result in higher returns. And next, in this model, if the Fed model works out to be true, then we would expect a significant positive coefficient here and a significant negative coefficient here. But if the Fed model is not true, we would expect a significant positive coefficient here and an insignificant coefficient here. And so the way that it comes out is V1 turns out to be 0.19 with a 2.57 t-statistic. So we see here that the earnings yield significantly explains the returns, with a higher earnings yield at purchase yields a higher return. And so in the B2, we get a 0.21 with a 2.62 t-statistic, and B3 comes to a negative 0.07 t-statistic, or coefficient, with a negative 1 t-statistic, which is very insignificant. So what we found is that the coefficient on the earnings yield is significantly positive, and the coefficient on the 10-year Treasury yield is insignificant, so basically zero. And so what this would mean is that the earnings yield, or the 10-year Treasury yield, does not explain the returns to the stock, and all the explanatory power is in this earnings yield figure, which goes against the notion of the Fed model that says changes in interest rates should result in changes in the return. So in summary, what we've found here, comparing this equation with these equations, is that the Fed model does have explanatory power on determining the earnings yield, but it fails at explaining the returns of those stocks. And so next, authors form a regression over a longer time period. For instance, these are annualized returns, whereas the regression before was monthly returns. And with this regression, we see significantly positive loading on the earnings yield to get returns, but also what we found before, there's an insignificant loading on the 10-year Treasury yield. So clearly, whatever long-term predictability there is in returns, it comes primarily from the earnings yield at the point of purchase, and not anything to do with the interest rates at the time. So in sum, if you're trying to predict which country is going to outperform the others, your best bet is to find the one with the highest earnings yield, and ignore whatever the interest rates are, which is what the Fed model asks you to do.